We have market expert Sunil Subramaniam joining us. Sunil sir, good morning. Sunil sir, it's a truncated week, but the 50% tariffs can take effect in 2 days. How do you feel about the markets at the current juncture?
I think the 50% tariff is a bad news that the market is already discounted. And I don't think with the US trade delegation postponing their visit back and the Trump Putin talks not leading to any great traction. If you remember, the second 25% was more of a political tariff. And we used, and even Mr. Vance, the vice president, has confirmed that was one of the strategies to bring Russia to the negotiating table. So it's not India specific. So there was a hope that if that leads to a resolution of the Russia-Ukraine crisis, the 25 might go away. But as things stand, I think with Ukraine bombing a refinery in Russia and Russia counterattacking, doesn't look like the solution is quite near. So this 50% is likely to remain and it's going to come into effect. But like I said, the market is already discounted. A little bit of positivity around it might go away. That's not there now. So let's take that the market has discounted that. But there's a whole host of positive news which the market can trade on. And that started with the Prime Minister's Independence Day speech, the S&P upgrade, and yesterday, of course, the Jackson Hole rate cut hope which the market has derived from. So the dollar index weakening and the rate cut, it's positive for equities, positive for emerging market flows, and hopefully India will get a share of that in the coming days.
Okay. So, sir, what about, given that the Fed has indicated for a 25, maybe a rate cut for September itself, what does it mean for our RBI to going on with its rate cut path?
So I think it definitely encourages RBI to do another rate cut because the interest rate differential will widen if RBI doesn't also cut rates. So that's number one. Number two, this 50% tariff wasn't there when RBI did their last policy. So I think the ongoing events means that there could be some impact on our growth. So there's a second factor for RBI to consider. But counter to this is the fact that the government has now done a fiscal boost through a GST reduction program. So RBI will probably wait to see whether that translates into good growth during the festival season. So while there is a supportive condition and inflation continues to be moderating very well. So the conditions are fairly evenly balanced between doing another rate cut and not. And I think that by the time next policy comes, we will probably have a better sense of the festival season, and that would play a larger role in terms of the Reserve Bank's action. But yes, the Fed rate cut may gets one more point in favor of a RBI rate cut in the near future, but other data has to come and support this. But that being said, the Fed rate cut itself is a positive for emerging market equities and positive for India. And second is that it's positive for the BFSI sector in the US, which is probably the largest buyer of IT products. I think about 55 to 60% of Indian IT companies' exposure in the US is to the BFSI sector. So something that's positive for the BFSI sector would mean that it's positive for IT. And IT has been a big underperformer. YTD or 1 year return, you see, IT has been probably the most underperforming sector in the Indian market. So from a relative valuation perspective, one of the reasons FIs are not rushing to come back to India is because we're still expensive compared to our long-term average, compared to other emerging market stocks. So from that point of view, I think the FIS return will come into an area where they feel there is some value and IT would be top of the ladder. So I expect that return of FII would correlate with a movement up in IT, though on the ground level, their earnings season was what it is, and there's nothing really changed. But the outlook for IT with a positive outlook on the BFSI space in the US, I think could be positive. So there is relative value, I would say. It's not that it's a cheap sector, but there's relative value in IT with an FII return, around the horizon.
Okay. So, Sunil sir, does this mean that IT could be the late bloomer of this year itself?
I think so. I think I'm one of those who, like 4 5 months ago, was negative on IT, then changed my view. I've turned positive, more saying that this is the best contra pick. And like I said, I would correlate the fall in IT over the last year to FIS selling. And so, with all the positive news coming around India, both from the S&P, again to reiterate the government's boost in, from a consumption perspective and the supportive RBI. So I think there's a lot of money gone to the China and to the South Korea markets in the FII pool. So I think those markets have now run up very well. And China, despite the economic news not being great, the markets are roaring there. So at some point of time, there will be a reset. I think Chinese valuations vis-a-vis their growth will not look so attractive, and there'll be some shift towards India. And second is, I think passive funds, right? We have about 17% of the emerging market index. So passive funds, when they get money for emerging market because of the Jackson Hole indications, means that India will get 17% of passive flows in. So which means that compared to the previous when there wasn't any flows, to get 17% of whatever incremental flows come, and in the passive 10% is the IT index, in the emerging market, in the MSCI India index. So that amount of buying support which was lacking will mean that definitely IT will get a leg up purely based on these flows. So I would say yes, IT, you put it right, it's a late bloomer in this year.
Okay, okay. But so what does it mean? What do these tariffs mean for the export-oriented sectors? We of course seen some caution coming in for the gems and jewelry, and then we had textile stocks which came under radar. But last week we did see government lifting that import duty from cotton. So can this just act as a temporary reprieve, or how do you see this to pan out?
Definitely, the government, even the GST cuts, I would say, to the extent
Hmm.
that up the value chain, there's a reduction in taxes and costs, would make them a little more competitive. The
Hmm.
RBI not doing a rate cut means they could depreciate the rupee a bit, which is again a protection against tariff. So India, it's not as if we don't have weapons against this 50% tariff. So the government clearly has gone on the front foot with the GST. So I think that we will do necessary support to the export-oriented sector. So to some extent, you can view that this kind of a correction on those export sectors is a bit overdone, but it is still a risky play because we don't know. The US keeps threatening. Mr. Navarro, who's the supporter of Mr. Trump and who's his
Hmm.
advisor, is going strong heavily against India. And who knows, this 50% should remain at 50, or if because Russia is not yet responding to Mr. Trump's overtures, Trump could increase the pressure and he could add additional tariffs on India too. So it's a little bit of a fluctuating situation. So I would say that at this point, stay cautious around that. Though I think a lot of this correction is overdone, in my opinion, but there could be some more correction coming through. So stay focused on the domestic side at this point in time, and let's wait for further clarity around the whole tariff scenario, in the coming weeks.
Okay, okay, okay. So do you believe that, this inflationary impact that could come as a result of the tariffs itself could be offsetted by the GST rationalization that the government has been planning?
No, I don't think there will be an inflationary effect. Is going to be on the US
Hmm.
consumer, right? The
Hmm.
tariffs are going to apply to the US consumer. So I don't think there's any India inflationary impact that this is going to counter, right? Like I
Hmm.
said, for the government, they have to make our products competitive with the competing nations. They
Hmm.
are having only a 20-25% tariff. We are having a 50%. So that difference needs to be made up. And it's a three-pronged strategy. GST is one, currency depreciation will be second, and any export related, financing related incentives, like giving them cheaper loans. So government has some tools which they will apply, but inflation is not a concern because it's the US inflation. So I don't think that India is too much worried about the US inflation. We are more worried about making our exports competitive.
Okay, okay. And now that GST rationalization is just the talk of the town, how do you feel about the consumption making a comeback? Do you believe that there's going to be a pivot from the capex to the consumption related stocks?
Well, I think last week saw that happen. We think we brought in between 3 to 5%. All the consumption stocks and the indices had a strong rally. Now, the key is that there is going to be some disappointment in the near future because obviously the GST Council has yet to meet. They're meeting in the month of September. The effective date for the GST reduction has to come through. So all the stocks of the dealers have piled up at the various, companies have piled up at the dealer outputs, right? Now,
Hmm.
will a customer postpone his purchase saying, let the GST come through, let the effective date come through, I'll get a cheaper cost a month from now. So to that extent, we might see a softness in their sales, that the stocks piling up. There'll be interest in inventory costs, inventory financing costs for these companies. So, and they will might do some discounting to push the sale. So it's a mixed bag today. So I think the last week's run has caught a lot of the rally. There could be a little bit of a leg there, but I would say that let's wait for the GST Council to meet, let all the states agree to it, and let them agree on an implementation date. Once that clarity comes, that will then mean that we will can look further at again consumption. So at this point in time, the rally has happened. Let's just wait. But I would argue that the capital goods infrastructure space is something you should look at, because GST is going to lead to a postponement of the consumption, right? Because of the GST. So by Diwali, definitely this GST will be in place. So sales should go through. So from that point of view, I look at it as the second derivative, that what happens if the consumption goes up is that capacity utilization goes up, and private sector capex, which already there's green shoots coming. I think L&T's chief had given interviews where he said private sector capex is coming back, their order book is growing, but it'll get a further leg up when capacity utilization moves up. So I believe that the smarter thing to do is to buy these capital good related plays before this news becomes very much public. And in about a year and a half from now, these execution of these will mean fabulous order books for the mid and small cap suppliers of EPC contractors, cement, steel, building materials, the whole pack. So I would say that's a better thing to do today, is to buy those, because consumption is the flavor of the month. Everybody's eyes are focused, but this is a second order effect, and better you bet on that with a slightly medium term outlook. And along with the infra capital goods pack, I would recommend to look at the public sector bank pack, because financing for this entire capex cycle to the mid and small cap companies and the MSMEs is going to come from the PSU banks, who have greater comfort, knowledge, and past history in dealing with these companies. So I would say that the PSU banks would also benefit from that. So my recommendation is to actually, take a staggered call on the overall infra cap goods space plus PSU banks today.
Okay, infra good and PSU banks. But Sunil sir, what does it mean for the sin stocks? See, they've also said that 40% of tax could be imposed on tobacco stocks, tobacco companies itself. So, what does it mean for stocks like ITC, Godfrey Phillips, or VST Industries, for that matter?
Ever since I've been tracking the markets, sin has always been punished, but the sinner has never reacted to the punishment. He's only kept on sinning, if you want to call it. So I think that any correction which happens because of these kind of a news is actually a good buy, because these sin products are there for a reason, that people like to do these things, right? They may not be good for their health, they may not be good from a social moral perspective, but there is a human tendency to do it. So I think that this kind of a market reaction to this news is actually a good opportunity to buy, because ultimately let's recognize the fact that I know it's a controversial statement, but sinning is a part of life. There will be people who will do 0% sin to 80% sin, right? So there will be that band. And to think that a cost increase is going to make a big difference to their consumption is, I think, wrong. It's like gambling, right? Just because gamblers keep losing, they keep gambling even more. So your cost increase means that much more out of his pocket goes towards cigarettes or whatever you want to do with it. So to me, right, that's a very resilient industry, if I may say, right? Because those people are bucks. They are like smokers, not going to give up just. Yes, the overall percentage of smokers will be coming down and all of that. But those who are already inveterate smokers are going to continue to buy their cigarette pack even if it's costlier. So I would say that that ability of these companies to pass on increase the costs or tariffs to the consumer is probably high. It's like they say, the elasticity, right? That's very low. They can keep on passing on these costs and there will be no change in the demand. So I would say that arguably, as a contra bet, you actually go and invest in these sin stocks to the extent that the news is leading to a correction.
Okay, okay. So you say quite positive on even the sin stocks for that matter then, apart from PSU banks and infra-related plays that you have mentioned earlier. But apart from that, anything else that you're liking in the markets right now?
No, see, I think that this explains it. Like I said, for me, IT and the sin stocks are the contra plays. I think that consumption has seen a good rally last week, so I don't expect too much further growth. It's more of stable. For me, private sector banks, right, are the ones also who are probably going to benefit from this Diwali festival boom. Because EMI based financing, private sector banks and NBFCs are the ones who have got a significant market share there. Their deposit growth has been good for the private sector banks over the last quarter, because people have taken this 1 lakh crore of tax giveaways and put that into savings, right? So I think that that's a they are flush with funds. I think from a credit deposit ratio, and they are geared up to lend, and they will pass on a bit more of the interest rate cut. You're thinking about 77, 78 bips of the 100 basis points is what RBI governor mentioned has been passed on. But I think the balance will go through. So I think there'll be a huge bump up. So along with the consumption, it's the private sector banks which are going to see a huge growth in their loan book in this festive season. Of course, the impact on margins may be there, but that's okay because the volumes will make up for the drop in margin. So on absolute EPS, it's a net interest margin into the loan book, right? So I think that will still show a good growth. So from a shorter term bet, for me, the private sector banks and the larger NBFCs in the lending space are a good bet. Also, I like those also.
Okay, okay, all right. All right, with that, we have to let you go, Sunil sir, but thank you so much for your time and joining us.